All right. Today is Wednesday, June 15th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and happy Fed Day. We got the FOMC minutes out of the way, the conference by Jerome Powell, and it was one for the books, a historic decision of raising interest rates by 75 basis points. The last time we've seen this was in 1994, and you might have noticed that the stock market responded positively to the announcement of the 75 basis points, and it is now dubbed as a relief rally. Now, is it going to last? Is it not going to last? This is what we're going to talk about in this program, but we will also decode what Jerome Powell said, because the assumption for now is the stock market responded positively because Jerome Powell did the 75 basis points, meaning he responded to the CPI and the incoming of data, number one. But number two, in the conference, he also hinted that perhaps the 75 basis points increase will not happen again. And market participants and the analysts, the observers, the commentators are now saying that this is the reason behind the rally that we got today in the stock market. I say be careful. The devil is always in the details. We're going to go over what Jerome Powell said in details, and I'm going to dissect and decode everything he said. So buckle up your seatbelts and grab your adult beverages, and here it is, in focus tonight. Delusion. Jerome Powell remains delusional about inflation despite the 75 basis points hike. We start with the data that we got today in the morning, hinting for more stagflationary forces in this economy. For example, today we got retail sales. Retail sales went down. It appears that the trend for now is downward in retail sales. They continue to talk about the strong consumer, that the consumer has never been stronger, but we're now seeing the impact of inflation in consumer spending. It is eating away savings and forcing the consumer to swipe those credit cards up and down, up and down, up and down, racking an insane amount of debt. And therefore, the consumer has to prioritize their spending. And they're moving from spending on goods, services that stimulate the economy into spending on essentials such as gas, utilities, rents, and groceries, because they're forced to do that by inflation. Now, here's another point. A lot of folks assume that once the demand eases in the economy, whether it is forced by inflation or otherwise, we're going to see inflation moving down, which is absolutely comical because the case could not be any further than this assumption. While retail sales are going down, the majority of the decline last month was due to auto sales. Auto sales went down significantly. So now you might ask, hey Maverick, we're not seeing demand on auto sales like we've seen before. The consumer cannot spend on these big ticket items anymore, and therefore automobile prices should be going down, right? Well, you're wrong. Here it is from the Kelley Blue Book. New car prices nearing record highs. So you're seeing the pace of economic activities of buying new cars moving down. But prices continue to move higher, and hence stagflation. Also this morning, we got another alarming piece of data, this time around from the New York Empire State Manufacturing Index. And maybe you can see this or not, but if you're having a hard time seeing it, pause and look at the screen and you will see the details. But according to the survey, the current indicators, we're seeing weakness in the headline reading. We're also seeing plateauing activities in new orders, shipments, and declining readings in unfulfilled orders, delivery times, while inventories continue to move higher slightly. But again, prices paid continue to stay higher. They're not moving down, even though the pace of economic activities, such as the headline reading, new orders, and such, are actually plateauing. Prices received remain high, and the number of employees moving higher slightly, while the average employee work week is actually moving down. But here's the problem. When we look at the forward-looking indicators, all of these readings, the headline reading for the business conditions, new orders, shipments, unfulfilled orders, delivery time, inventories, all moving down significantly. So according to the survey, expectations in the future are increasingly becoming of slowing down of the economy and a slowing down of the pace of economic activities. But when we look at the prices paid index, for example, we are still seeing elevated readings, be it for prices paid or even prices received, which means the expectations in the future are for stagflationary forces according to the Empire State Manufacturing Index. Now, are you looking forward for the 4th of July? Barbecues, beers, right? Well, it's going to cost you an arm and a leg because inflation is surging out of whack. And now the cost of the 4th of July barbecue went higher by 21% to $71.98. That is not including alcohol. And I say with alcohol and with reality, it's going to cost you about $200, and that is for a small family. But rest assured, Hold tight because aid is coming from your government. $1 billion this time around. Oh, I'm sorry, this is for Ukraine, not for you. And we're now seeing the beginning, the hints of the upcoming tsunami of layoffs and unemployment in the economy. From the great resignation to the forced resignation, tech companies are shifting to layoffs after a huge ramp up in hiring. Tesla, for example, is laying off 10% of its huge workforce. Spotify today announced reducing hiring growth by 25%, and real estate firms Compass and Redfin are announcing layoffs as we continue to see the housing market slowing down significantly due to rising mortgage rates. And of course, the layoffs are happening in undignified and humiliating fashion. We continue to follow up on the story from Coinbase. Now these employees, they found out that they lost their jobs via Twitter and by the fact that they lost access to their work laptops. So the company doesn't even have the humility to tell you face to face, hey, you're going to lose your job. You lost your job. I'm sorry. And this is why. We wish you the best, etc., etc. No, they're not going to even talk to you. You're just going to find out via Twitter that you lost your job. This is as humiliating as the financial crisis, if you remember, if you recall. Back in 2009, when people were losing their jobs, companies did not talk to their employees. Some employees have been working for 20, 30 years with the same company. Yet these employers hired outside companies, third parties, to announce the layoffs to these employees in a humiliating fashion. Grab your stuff. We are from firm so-and-so. We're hired on behalf of your employer. You lost your job. Here's a little packet to guide you through this next phase of this journey. Wow. We got more alarming signs about the economy, folks. Today, the Atlanta Fed GDP tracker, which went down from 2%, actually was plus 2% a few weeks ago. It went down to 0.9% last week, and now we got the update. The Atlanta Fed GDP tracker is now down to 0, and soon enough it's going to go down negative. So the recession is being confirmed this time around by the Fed itself. And according to surveys, the probability of a recession by the first quarter of 2024 is now rising to almost 80%. What does that mean? The recession is coming. It is in the bag. It is inescapable at this point. And according to another survey, the majority of Americans now believe that the U.S. is already in a recession. Wow. But the overwhelming majority, even those in denial, believe that the U.S. economy will be in a recession within the next 12 months. The readings are the highest among the lowest income earners, among minorities, of course. But for the majority of groups, over 50% believe that we're already in a recession, with the exception of Democrats and those earning above $100,000. They'll come around because this is inescapable. And when we look at these two groups, also the overwhelming majority of them believe that the U.S. economy will be indeed in a recession within the next 12 months. And why are we seeing this souring sentiment, by the way? Number one, the wealth impact is moving down. A lot of folks are losing their jobs. A lot of folks are facing inflation. Their spending power is down. Their standard of living is down. And on top of that, retirees and those invested in the stock market are not happy seeing their portfolios down big, while the burden of borrowing and spending in the economy is increasing dramatically. For example, look at the 30-year mortgage rate. It is now hitting 6%. And of course, look at your credit card interest rate. It is skyrocketing. So soon enough, you're not going to be able to even swipe those credit cards up and down, up and down, up and down, because it's going to cost you an arm and a leg. And oh, by the way, you lost your job too, so you're not going to be able to pay your debt, and now you file for bankruptcy and game over. We're seeing inflation skyrocketing, folks. This is causing consumer sentiment to drop like a rock, the lowest in history. And of course, along with the decline in consumer sentiment comes the decline in Joe Biden's approval ratings. We will see this economic crisis morphing into a political crisis this upcoming November. And the dominoes are falling, folks. The first casualty is Janet Yellen. Janet Yellen, now it's in the bag that Janet Yellen will be axed in November. They're not going to keep her as Treasury Secretary. And we're all waiting, when will they give the axe to Jerome Powell? Because for now, Jay Powell got renominated and he got reconfirmed by the Senate, the Congress. But at what point does it become such a political burden for the Biden administration that forces him to do the unthinkable of axing the Federal Reserve Chairman? That could happen, folks. If we see a wipeout in November and inflation sticks around, there is a possibility that Jerome Powell could be the next casualty. And of course, since we're talking about the Fed and the announcement of a 75 basis points increase in the Fed funds rate, the tightening cycle QT, we're moving from QE, the cocaine era of easy money, stimulating the economy and the stock market artificially, to the reality that will be induced by QT, for recession, for crashing stock market, for crashing housing market. But of course, the Federal Reserve remains delusional, specifically Jerome Powell and his allies in the media and the so-called perma-bulls and the perma-pumpers in Wall Street. They believe that we will have a soft landing, while history actually suggests otherwise. In the previous cycles of tightening, in the majority of these cycles, the tightening resulted in a recession. Very few incidents that happened before where the tightening did not lead to a recession. So the assumption for now is this tightening cycle will lead to a recession. And do you remember the misery index? Let me know in the comment. Or maybe you shouldn't, because you're going to let us know your age, because that was back in the 70s and 80s. The majority of folks today don't even remember the misery index. But since the 80s are coming back with Stranger Things and Top Gun Maverick, guess what else is coming back? Yep, the misery index. And the Fed chairman, who promised that with his reckless policies of unleashing the biggest tsunami of liquidity in human history in response to the great panic of 2020, he promised that it's going to be a wholesome recovery, that it's going to touch the middle class, the poor, all lives will be elevated. Well, now it appears that the hammer is going to come down on all of us, because to kill this inflation at this point, the Federal Reserve will have to kill the economy. And guess who's going to feel the bulk of the pain? The poor and the middle class. The rich, the 1%, the oligarchs, they've already benefited from this massive bubble induced by the Fed's action, this inflation induced by the Fed action. They made a killing in stocks and real estate, and they dumped at the top, cashing in all of these gains. They're ready, locked, and loaded for this upcoming recession. They're rubbing their hands. They cannot wait for this recession to happen so they can scoop all of these assets again for pennies on the dollar. But you and I, the poor, the middle class, working folks, we are going to feel the pain. The Federal Reserve has been in denial and contradiction and confusion, and therefore you're seeing the insane reaction in the stock market because market participants don't have any faith in the Fed anymore. The Fed has been all over the place, starting with transitory, and then not transitory, then we're not thinking about tapering, then we're not thinking about increasing interest rates, and now increasing interest rates by 75 basis points in a single meeting. Who would have thought that that would happen? I'll tell you who. The guy you're listening to right now. Not last week, not last month, but over a year ago, we've already forecasted that we will be in this situation right now. And this is all due to the incompetency of the Federal Reserve led by the delusional madman Jerome Powell. And with that out of the way, let's review what Jerome Powell said today in the FOMC meeting and the conference that followed thereafter.
Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic.
Oh, I'm sorry, that's the wrong conference. That's the one when they cared about Ukraine. Now all of a sudden they care about the domestic economy. And I'm going to break this down for you in 5 points. Number 1, the higher expectations, the 75 basis points, what happened, what was behind it, etc., etc. And then number 2, delusion. Jerome Powell remains delusional. Number 3, the denial. He remains in denial. Number 4, unemployment, the upcoming tsunami of unemployment. And lastly, the conclusion of this charade that we got today from Jerome Powell. We start with higher expectations of why the Fed moved from 50 basis points to 75 basis points increase in this meeting, but perhaps more stunning, moving the Fed funds rate target from 2.5% to 3.6%. Take a look.
Resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy.
Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations.
We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value.
Now, on one hand, you could say that the stock market appreciated the response by Jerome Powell because we got the CPI on Friday, we got consumer expectations of inflation on Monday. They're all bad. And the Fed responded immediately by increasing their hike from 50 basis points to 75 basis points. So on one hand, the stock market, and all of us, to be frank, are saying, okay, maybe the Fed gets it now. Maybe the Fed is finally responding and doing what it needs to do to tackle this inflation. On the other hand, is 75 basis points enough to tackle this inflation? That is number one. Number two, isn't the Fed chairman chasing inflation? Isn't the Fed being reactive, not proactive, in tackling inflation? So what does that mean? It means that inflation is in the driver's seat right now. Inflation is going to guide this journey, and Jerome Powell and the Fed will respond after the fact, and this is very dangerous. Remember that Paul Volcker was proactive. He raised interest rates above the CPI. He went ahead of inflation and said, I'm in charge. I'm the one in the driving seat, not you, inflation. But Jerome Powell is so shy and timid, and perhaps delusional, and many other things that I want to say that I cannot say. And he says, no, I'm going to stay in the passenger seat, and I'm going to wait for inflation to make the next move, and then I'm going to respond. But what exactly got the Fed chairman to increase the hikes from 50 basis points to 75 basis points? What specific piece of data that caused him to do that? Because he said the CPI, but what else? Here it is. Take a listen.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data. But I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So keep in mind, he said inflation expectations. Even if we see a couple of indicators showing us that inflation expectations are getting out of control and not being anchored, we're going to respond. So here comes the question from the journalist saying, so are you going to do it again if the data comes out hot? Once again, are you going to increase your hikes from 75 basis points to perhaps 100 basis points? Watch how Jerome Powell weasels around this question.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be.
And you wonder why folks have no confidence in the Fed when he cannot answer a clear question. You just said that you're going to respond to the data. Okay, the guy tells you, what if the data comes out hot? Instead of saying, we're going to do whatever we need to do. And if it is going from 75 to 100 basis points, we'll do that. Instead of saying that, he weasels around, gives no clear answer. You wonder why we have a lack of confidence in the Fed? And here's another question asking, why 75? What is so special about 75 basis points that 50 could not do? Why not 100? What is so special about 75? Why 75? Does the Fed has any work frame that when the CPI data came out hotter than expectations, they looked at that work frame and they said, okay, that merits a response of 75 basis points exactly. Take a look.
Thanks for taking our questions. Gina Smirlik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for.
And of course, Jerome Powell, once again, I'm going to save you the agony of listening to his answer because he did not answer the question. Why 75? He couldn't answer the question. Why? Because in reality, the Fed has no formula, no work frame. They're just eyeballing inflation. They're eyeballing the response to inflation now. By eyeballing inflation last time around, and they just assumed it's going to be transitory, we got to this inflation crisis. Now, they're eyeballing the response to this inflation. This is a recipe for an upcoming disaster. Now, let's move on to delusion. And we start with Jerome Powell's take on the economy, the GDP, and consumer spending. Take a look.
Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment.
What's with the and he's reading from a paper, folks. The guy has no charisma at all. Why not just look the American people in the eye and speak from the heart, Mr. Powell? And then he says recent indicators show that real GDP picked up this quarter. Buddy, what are you talking about? Which planet are you living in? Your own Fed, the Atlanta Fed, came out today and said that the GDP in the second quarter will be at 0%, if not negative. But he says, oh, GDP is moving higher. This is the delusion. And then when talking about the consumer, this is what he said.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy.
So he said the consumer is in a really good shape financially, and he doesn't see any slowdown in the economy. Well, perhaps you need better glasses, Mr. Powell. We have data indicating the U.S. household savings rate absolutely collapsed to the lowest level since 2008. On the other hand, consumer borrowing and usage of credit cards is skyrocketing. Do you have access to this data, Mr. Powell, or should I send it to you? And then he says consumers are spending. Everything is great. What are you talking about? What are you talking about? Have you seen the data that we got this morning with retail sales going down? Jerome Powell remains delusional about the status of the economy. But if you thought delusion was the scariest part, wait till you see the denial, because Jerome Powell has another trick up his sleeve to clear himself and the Fed from the responsibility of this inflation. Take a look.
I have to look at it this way. We move the policy rate. That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. we'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
So now he says that the Fed has certain tools, such as increasing interest rates and manipulating consumer expectations of inflation. And that leads to tighter financial conditions. We're already seeing that. And that should reduce the demand in the economy and hence reduce inflation. And then he goes on and says that we don't have control over commodities, which is absolutely false. Now, tightening financial conditions, such as crashing the stock market, for example, will not reduce the demand in the economy and hence will not reduce inflation. And even if demand goes down in certain areas of the economy, there is no guarantee at all that inflation will go down. And hence, we have a phenomenon called stagflation. Now, what Jerome Powell is weaseling around and not being earnest about is unemployment. When he says reducing demand in the economy, how do you think that will happen? In this channel, I gave you my conditions of how this inflation will die. Stocks have to go down, real estate values have to go down, interest rates have to go higher, along with unemployment. Now, stocks are already down, but not down enough. Real estate values remain elevated. We're seeing stagflation in the housing market. Prices continue to be higher, while the pace of economic activities of buying homes is slowing down dramatically. We're seeing rates moving higher slightly, but not enough. And we're not seeing unemployment in the economy. Now, whether you like it or not, the truth is, to kill this inflation, you need all of these factors satisfied. Most importantly, unemployment, because housing prices will not go down without unemployment in the economy. If folks are still employed, they're going to hold on to their homes. They're going to continue to pay that mortgage. And the supply is nowhere to be found, so there is no inventory. The supply will take years till it hits the market. And by the time it hits the market, we will be in a recession already. So the only way to ease price inflation in housing, specifically rents, you need to induce unemployment in the economy. Unemployment will only happen if interest rates move dramatically higher, tightening those financial conditions enough for companies to start laying off employees. Now you might say, why would we do that? Because if we don't, inflation will move significantly higher, leading to stagflation, and stagflation will cause unemployment in the economy either way, but by that time, inflation will linger higher while unemployment will continue to rise higher, hence stagflation. And by the time the Fed finally responds, that cushion of low unemployment will be gone from the economy, and instead of having perhaps a mild recession, in that scenario, we will be looking at a prolonged recession, if not a depression. But what's really notable here is Jerome Powell cleanses any responsibility from the Fed when it comes to commodities inflation. He says commodities can move higher on their own. We have no control over that. That is baloney. I explained to you in a previous video that a huge part of the inflation in commodities is due to excess speculation. What causes excess speculation in the commodities market, pushing the prices of these commodities higher? The answer is excess liquidity. The Fed must remove the liquidity and the accommodation from the economy for commodities to ease down. The Fed funds rate, even after this increase, remains at around 1.5%. This is not restrictive at all. On top of that, the Fed's balance sheet ballooned to astronomical levels, and the Fed hasn't even began trimming the balance sheet seriously. So that excess speculation pushing commodities higher will continue to be with us. Inflation will continue to move higher, and the Fed will continue to chase that inflation. This is a bad dynamic here, folks. Jerome Powell should have taken responsibility that his action caused the inflation in commodities to begin with, and then the exogenous factors such as the pandemic and the Ukraine war take the second responsibility. But he didn't bother to do that. And on top of that, he was not frank with the American people that to reduce demand in the economy, unemployment has to happen. More in denial. This time around, he was confronted by a reporter of the fact that the Fed omitted a sentence from the FOMC minutes. Now, why would they do that? Take a listen.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So, as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years, and it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though, so I'm wondering if you could explain why that line was removed from the statement, and also whether This means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in, prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
So they took out a statement that said that the labor market can remain strong even as the Fed tightens the monetary policy to combat inflation. Why did they take that out? Because Jerome Powell repeatedly throughout this conference said that we're going to tackle inflation and the unemployment rate is going to move higher slightly to 4.1%. No big deal here. Why did they take that out from the FOMC minutes? Now, Powell says because we don't have responsibility or power over commodities inflation, which is false. I just explained to you that excess speculation in the commodities market is responsible for that inflation, at least responsible for over 60% of that inflation. And then comes the supply factors. But by omitting that statement, is the Fed indirectly saying that we're going to see a recession, that inducing a recession is important to tackle this inflation, that unemployment might go significantly higher? What are they hiding here? What is Jerome Powell hiding? How about the truth that to effectively tackle this inflation, unemployment must go significantly higher? And this leads us to the next segment of unemployment.
The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections.
Now notice, he said that the unemployment rate will go from 3.7%, which is the rate right now, to 4.1% in 2024. So what happens between now and then? This is what the Fed is hiding, folks. They're telling you it's going to go from 3.7 to 4.1. Not a big deal here. Don't get alarmed. Don't be concerned. But what happens between? And are we really going to buy that the unemployment rate is going to be at 4.1% in 2024? What guarantees do you have for us, Mr. Powell? What if the Fed is hiding the fact that the unemployment rate could skyrocket to above 5%? Maybe 6%, 8% in 2023, and then it comes down to 4.1 or 4.5 in 2024.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Successful outcome, you say? Yeah, you lost your job, but that is a successful outcome according to the Fed. Wow. The reporters did a good job today, and they're not going to let him get away with this. Here's another question asking about perhaps that the economy needs more pain for inflation to subdue. Take a look.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things.
So here he is again. This is a fantasy, by the way, that inflation is going to go down and the unemployment rate is going to just tick higher. Oh, to 4.1%. No big deal here. Really? You think getting the unemployment rate to 4.1% will kill this inflation that continues to move higher? According to the CPI, aka the CPI, at 8.6% right now. In reality, it is above 20%. You really think that moving the unemployment rate by 40 basis points will do the job? Are you delusional? But most importantly, why are you hiding the facts and the reality from the American public? Why not just come out and say, folks, this is going to be a difficult period in the economy. We're going to see a lot of jobs being lost. But unfortunately, at this point, because I up in the past to clean up my mess, the only way to tackle this inflation down is to induce higher unemployment in the economy, much higher than 4.1%. And lastly, in the coverage of the FOMC, here is the conclusion.
Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too, also other things. So we can't really have much of an effect.
A lot of folks started jerking off prematurely based upon the reaction by the stock market after the conference by Jerome Powell. But here's the problem. If you think that this is the end of the 75 points increases, think again. The next increases will make you wish for a 75 basis points increase. Why? Because the Fed can no longer deny the facts. The Fed can no longer anchor the policy based on core inflation, which strips away food and gas and oxygen and everything important to the consumer. They have to anchor their policy based on the headline inflation. Why? Because of inflation expectations. Now, ladies and gentlemen, you know what this means? This means higher interest rates because the headline reading will continue to move higher and higher and higher based on the inflation in energy prices, which means higher interest rate hikes to come. So if you're celebrating about the stock market reaction in the aftermath of the FOMC conference, be careful what you wish for. And lastly, how did the Fed get it wrong? Take a look.
I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent.
How about incompetence?
It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. Is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine.
And here he goes again with the excuses. Oh, it's the pandemic, the lockdowns, the supply, China, Ukraine, Jupiter, Uranus. No responsibility at all. This is the incompetent fool, Jerome Powell, that leads the most important policy making in this country. And of course, the geniuses, the pumpers, came out of the woodwork after the meeting and the conference, led by Jim Cramer, who's been wrong about everything for 2 decades now, at least. He came out warning bears that Jerome Powell will do whatever he needs to do to tackle this inflation. Watch out! In other words, Cramer is suggesting a short squeeze based on the 75 basis points that Jerome Powell took today. The pathetic 75 basis points hike, which is nothing in the grand scheme of things. The CPI is at 8.5% minimum. The Fed funds rate is barely at 1.5%. They're still way behind the curve. And oh, by the way, Douchebank says that earnings estimates are still too high when you factor in the fact that the majority of Americans now believe that the economy is already in a recession, which means that corporate earnings will be crushed down. And the estimates that we have right now are simply overinflated, meaning that anything you see regarding valuation metrics, be it the forward PE ratio or the actual PE ratio, saying, hey, valuations are down, perhaps stocks are getting cheap, all of these metrics are not updated when you factor in a recession. If earnings are going to go down, these valuation metrics remain elevated. More damage has to be done. Anyhow, folks, unfortunately, I've been busy all day, and I'm recording this too late, despite the fact that I was anticipating to be freer for the remainder of the week. But unfortunately, we have to skip the rest of the segments in this program and stick to the charts analysis and then wrap it up. So let's do that and move on to the charts analysis, and we start with SPY, the S&P 500 30 minutes chart. Despite the positive reaction that we got after the FOMC, nothing changed at all. Be careful here not to get trapped one way or the other. You have a defined range. The support at 373.5, the resistance at 385.15. You can round that down to 385, doesn't matter to me, but nothing changes unless one of these two numbers is beaten. Either the chart breaks above 385 and closes above that number by the end of the day, that would be a confirmation that we're moving higher, or the chart breaks below 373.5 and closes the day below that number, that would be a confirmation that lower we go. So if you bought the dip today, assuming that higher we go, because whatever Jerome Powell said, whatever the knee-jerk reaction is, who's to say you're not going to get trapped again in another vicious bull trap? You have no confirmation whatsoever that this is the bottom for now, and therefore, I'm just waiting and seeing. Show me the money. I'm asking the chart to show me the money. Show me more proof that you're going higher, and then I'll buy. Show me more proof that you're going to go down, and then I'm going to short. Here's the daily chart for the S&P 500. The continuous contract. Anything changed today? Absolutely not. The chart remains within a range. The resistance at 3,855. The support at 3,720.5. Nothing changed today at all. The momentum indicators remain negative. The volume went down slightly on an upside day. The volume is a good sign for the bulls that perhaps we're seeing selling climax, but who's to say that the reaction we got today is nothing mere of a knee-jerk reaction? Matter of fact, I'm not going to buy until I see this chart closing the gap above and closing the day above 3,855. Better yet, after reclaiming the support of 3,960. I'm not going to short until we see 3,720.5 lost to support. Here's the 30 minutes chart for the Qs, the NASDAQ. What's going on here? Nothing changed, folks. It remains within a range. The support 274.65, the resistance at around 285. You're not going to buy until we have 285 cemented as support, meaning retested, closed above by the end of the day. Better yet, closing the gap above, which happens to be at around 290. Again, show me the money. I'm not going to fall for another trap. I'm not going to eat another pie. I'm trying to lose weight here. On the other hand, if you assume that this is going to go down and you short right away, you short it right away by the end of the day, who's to say we're not going to blast higher? Why not wait till the support of 274.65 is lost? Here's the daily chart for the continuous contract for the Qs. Again, it remains within a range. The support at 11,058.5 in my chart, we can round that down to 11,000 even. And then we have the resistance at around 11,689. Nothing changed here. The momentum indicators remain negative. The MACD, the RSI, the volume remains the same. I would be interested in buying if we see a successful crossing in the MACD indicator, giving us a confirmation of a bullish momentum. And on top of that, I need to see more support being recaptured. Number one, 11,689, and better yet, 12,207. Moving on to the IWM Russell 2000. 30 minutes chart. What's going on here? Nothing changed, folks. The support remains at 168.90. The resistance remains at 174.22. You're not going to buy until we see the resistance becomes support, and you're not going to short till you see the support becomes resistance. Here's a daily chart for the dollar index, the Dixie. What's going on here? It was a down day for the dollar index, but be careful. After all, this is tricky Dixie. It's going to play dead for a day or two, then it's going to pop higher again. So we're not going to feel out of the woods here until we see the US dollar moving down, erasing few more candles. And better yet, we get a confirmation from the MACD indicator by crossing to the negative side, producing red impressions on the histogram. Here's gold, the daily chart. What's going on here? It moved higher, bumping its head on the resistance of 1,840, 1,835. Doesn't matter to me, it is a zone. But it only moved higher because the dollar went down. Now, do we have any guarantee that the dollar is going to continue to move down? Absolutely not. The only way for equities to continue to rally higher is for the dollar to continue to move down. But if the dollar reverses and it moves higher again, gold will go down and so will equities. So be careful here. Nothing changed at all. What about Brent? 4 hours chart for crude. What's going on here? It went down and it's now hugging the trend line in yellow. Next we have 118 as support, but breaking the trend line is an ominous signal that we're going to see lower prices in oil. So crude better rebound from this point right now to recapture 124 as support. Here's a daily chart for the 10-year yield. What's going on here? It was a down day, but be careful of the knee-jerk reaction. What if this is a knee-jerk reaction? We see the 10-year popping higher again. If it pops higher again, this will be bad for equities. We will see lower lows in the NASDAQ and the SPY. Nothing changed here. It is a reversal candle, but we are awaiting a confirmation. Why is it a reversal candle? Because it reversed the entire body of the previous candle. But you have to wait for a confirmation. We have yet to get a confirmation that this is not a knee-jerk reaction. Here's the TLT, a weekly chart. It rebounded from the support of 109, 109.5, but there is no guarantee that this is the bottom for now. We need to see a confirmation that the 10-year yield is indeed moving down along with the dollar. And then we will see buying of the TLT, and that will come hand in hand with a rally in equities. The VIX 4 hours chart, what's going on here? Here's a good sign for the bulls. We're seeing the beginning of a negative momentum on the VIX, but it caught support after closing the gap at around 27.77. So who's to say that the VIX is not going to curl its way higher again and produce positive green impressions of the MACD again? We have no confirmation. The confirmation would be if the VIX loses 27.77 as support and continues to move down. Then we say, okay, the SPY may resume the bounce. Now, what about the VXN, the VIX for the NASDAQ? Look at this candle. I don't know if this is a glitch or an error or whatever it is, but I don't think we went down that far. This is probably a mistake by the chart, but are we seeing any red impressions in the histogram on the 4 hours chart of the VXN? Of course not. So we don't have a confirmation of a bearish momentum in the VXN and hence a bullish momentum in the Qs. That's number one. Number two, we have plenty of support here in the gaps. The VXN could go down to any of these gaps and then rebound higher again. So we have no confirmation at all that we have the green light to go along the Qs. Here's Apple, a daily chart, closed in the green today, but again, the negative momentum in the RSI and the MACD indicators are still here. The chart has yet to close the gap and it has yet to capture a support line. You're not going to buy until you see at least one support line recaptured and confirmed the support. In this case, it is 138.79. Nothing to see here. What about Tesla, the souffle, 30 minutes chart? What's going on here? We got the reverse head and shoulder formation producing a pop all the way to 700. It did not close above 700, closed at 699. The confirmation would be closing the day above 700 for the day. And then Tesla bulls will feel that they're in the clear. Without that, who's going to say that Tesla's not going to reverse all of these gains tomorrow and trade down? Recapturing support lines is an important indicator for a confirmation that the action that we got today is not a knee-jerk reaction. And lastly, tulips, what's going on in BTC? This is an ominous signal for the Nasdaq and for the bounce, for the dip buyers. Because if we are in risk on, why didn't Bitcoin participate? Why is it still trading flat? For now, it is oversold. It is severely oversold, but it is forming a bear flag pattern. If the buyers don't show up to produce a pop in BTC, we're going to go down to 19,550 and perhaps below that. The conclusion here, folks, is I need to see more. I need to see the market showing me clear indicators that we are in risk on. Bitcoin has to move higher. The dollar must move down. The 10-year yield must move down. The VIX needs to cool down. I haven't seen any of that yet. Keyword, yet. And of course, we're seeing a massacre in the crypto arena. Crypto billionaires are losing their fortune in an astonishing rate. And of course, the sad story is the country of El Salvador, with the madman in charge who gambled the country's wealth on cryptos. Well, the country is now down big, but he continues to be in delusion, buying the dip over and over and over again. I'll give this guy till the end of the year before the assassination happens. Anyways, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims per usual for the week, that we have building permits and housing starts, and lastly we have the Philly Fed Manufacturing Index. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.